all right. That's what I like to hear. That means we can move forward. Hey, 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 Wendy, how are you? Hey, everybody. Hey, everybody. Nice to have everybody on. You guys do not know just how excited I am. People, you guys really, really make me happy just knowing that, there are people. I'm actually touching people around the entire world, and that really amazes me. And technology is really the field behind it all. So just want to let you guys know how appreciative I really am of you guys, and my plan is to make sure that you guys are successful and full, right? So let's. All right, everybody can see my screen, correct? All right, so let's go ahead and move forward. All right, now let me just say just a few things before we really get into the actual training. Um, what I want you guys to know is that during the new members training, which is held every Thursday, please be sure that you take notes. I want you guys to take notes because that's going to be your tool to really, only you can take the best notes for yourself. So if you take notes the way you comprehend things in the way you can understand them, it will help you with your growth. All right, so please take notes. That way we can, I can see that each one of you are actually growing, and you'll have more tools to refer back to. Just a few pointers up front before we really get into it. The members area is pretty much done. All right. What I will have you guys do for those of you who have came in before the members area had even started. I'm going to have to get with each and every one of you to have you set up a username and password and all of that. That way you can gain access. All right. Everyone else who actually joined since we had the actual members area in place, the infrastructure there, you should have been, you should have been able to create a username and password combination where you can get in. If you have problems, let me know. That way I can make sure that you gain access. All right, we have a number of videos back there that I believe will be very, very, very beneficial to you guys. Can you guys hear me? All right. Just check. All right, so I really want you guys to make sure that you're able to. I just want to make sure that you guys are able to sign in and access those videos because there's some powerful information back there. And just as I said before, a long time ago, I was definitely going to keep my word. Remember, if you have any questions, We may have time at the end to answer questions. I may, from time to time glance out and ask some, answer some questions just to make sure that everyone is getting an idea of what's going on, or, if you have questions that need to be answered, I can ask them. Something else that's very important too is if you have questions, write them down at the end of the training. What I can do is you can email me your questions and then I can, respond to you accordingly. All right, and that works best for you. So, I might not be able to get around to every question, but that's just how this is going. I want to make sure I put as much time as I can into the training session. All right. So one last thing, the I can probably let's see. All right, let's go ahead and get started. All right, so we're going to go ahead and go over the first part of the new members training. Now, for most of you are probably coming from having a somewhat of a short-term trading mentality. I am one. I would say that I am biased. I'm pretty much a long-term trader. And basically what I am, my ploy is to get you guys to see the benefit of trading long term. Not necessarily for a month at a time or a week at a time, but just, trading, a couple of days at a time. I want you guys to get used to it because we're all here to make money continuously. And I'm going to show you guys why the long-term trading style is much more profitable and beneficial to your trading account. All right? Now, that being said, let me jump right into a demonstration that I had actually talked about before on one of my videos. All right? For instance, this is 1 day candle. All right? In 1 day candle, of course, you have resistance. You have support. All right? Anywhere on the chart. It doesn't, I just have resistance and support here. But let's just say this is resistance and this is support. And between this 1 day candle, you have 1,440 1 minute candles, 288 5 minute candles, 96 15 minute candles, and so on. All right? With 1 day candle, you can be at the forefront of heavy movement. While you have some people, they trade on the 1 minute. Look how much. Or an indicator. You have an engulfing candle. It indicates that the momentum is now on the engulfing side. All right. So when you're looking at, okay, do I want to be a day trader or a short-term trader? This is what you have to look at. Someone as a day trader, they can look at one candle, and it'll encompass all of this. All right. So let's go to the charts and let's look at what the daily chart looks like. All right, so let's go to I just created a video on this, so this shouldn't be too hard to follow. Let's see, what was that? Let's see, what was that? Okay, this. All right. Now this is the USD CAD. All right, and this is the 1 hour chart. Okay. Now what I want you guys to look at, I'm going to find an area with a very, very clear indicator as far as price action. That being right here. This is on the, actually, I'm sorry, let me go to the, this is what I want. This is the daily candle, the daily chart. And this is, each candle represents 1 day of movement. All right? So, 1 day of movement is over 152 pips. Okay? Now, just to let you guys know, if I had highlighted this, and if I went over to my hour chart, you're going to see how much data you would have to look at just to see this. This right here, this one candle is an engulfing candle. It totally engulfed the body of its preceding candle, of the preceding candle, which indicates, especially on the daily chart, that the move will continue in the bullish, the engulfing direction. That's going down. And look what happened. It went down. All right? So let's now look over at the hour chart and see how this translates. So if you were trading the hour chart, you would have to trade all of this. Probably not all of this because, you know, it was actually touching the candle next to it. But 24 candles basically. You would have to be able to look at this and determine which way the market is going. In between here, you had an engulfing candle going down, but the market went up. You also had a pullback. All right, so it could be a little, you know, it could throw people off. Engulfing candle, the market still went up, but there was a pullback. Up here, you had pullbacks, but the next day the market gapped down, and then it went down even more. For the next hour, it gapped down and went down even more. But it didn't go down it didn't go down any further than this, which is pretty much probably at a level of support. Then it went back up. So you don't really have any clear signs, and nor are the signs that you're getting, they are not well respected. This is the hour chart. But one thing for certain, looking at this area, I don't see any major signs that's really being respected. No price action is really being respected. Nothing like this. This one candle gave me the idea, it was the indication that the market was going to go down. And that's what happened. So when I go back to my illustration here, it goes to show that that 1 day candle, which is here, gave me the idea that the market was going to continue going down for 3 more. Well, I could have rolled the market down. You don't know how far it's going to go down, but look how many days it went down beyond this day. 3 whole days. And if I might add this up, I might look at what that is, pips-wise. Let's call it 250 pips. All the way to the wick, 280 pips almost. Wow. So you could have made an additional 280 pips just by looking at the day chart and seeing that the market painted an engulfing candle here, and it went down. However, if you looked at the hourly, you had to look at all of this and all of this. You could have easily been faked out with the market dropping down and then going up. It could have told you that. You could have read this wrong. Engulfing candle, which that is. This is an engulfing candle. It's bigger than its preceding candle. The market did go up. But how are you to know how far it was going to go up? For the next, let's say, 8 to 10 hours, the market went up before going back down. So you have to, for every hour, you have to be in front of your chart reading price action, which way the market is going to go. I think from a time standpoint and a monetary and a profit standpoint, I would rather look at the daily chart where I can see with one view that this is an engulfing candle and it's highly probable that the market will continue to go down. Rather than having to look at the hour chart, I can just find my way. Let's see. And as I said, rather than looking at the hour chart and having to dissect each hour in every pattern setup, that is not, and I say it again, it is the patterns that are painted on your hourly chart are not, they're not, price action is not all to, it's just one of them things where you are trading your hour chart, your 30 minute, your 15, your 5, and your 1 minute. The signals, they're not all that promising. They could give you a signal, and then all of a sudden it turns around like that. So you have to really look at the charts more often than you would looking at the daily. I happen to be a long-term trader because I enjoy my freedom. I enjoy being able to just scour the market, look for a setup, get in the market, and just ride it down, watch my money build, maybe stack some more trades, provide an extra strength, and just watch it ride down again when it reaches a level that I see that it's not breaking through. I'll just close out. All right. So this right here is a clear representation of why it's very important to trade on a higher time frame. 1 day candle could do all of this. Either 2 of these, 3 of these, 6 of these, 24 of these, 48 of these, 96 of these, 288 of these, or let's go with 1,440 of these. That is crazy. But nonetheless, you have people, they will trade these. And they have to sit there in front of their screen and sift through the madness to try to find a little bit of profit, because that's all you're going to get when you're looking at this. And I'm going to tell you guys something. This is the truth. What happens when you're trading short term, and my thing is not to discourage anyone, but a lot of traders, they trade the smaller time frames in hopes that they would make or find or realize or run where they can increase their volume when they're trading, thus compromising their account. And if the market goes against them, they get pulled out of the market. So why even risk the hard money that you've earned? Why even risk it? Every day, if I looked at one chart, if I focus on one chart, I really only have to look at the chart one time a day to determine if I'm going to trade or not. Everyone knows that the GBP is my trade of is my pair of choice. I could literally look at the chart, not at 5 o'clock necessarily, but I can look at the chart one time a day and determine if I want to get into the market for that day. I don't need to keep looking at it back and forth. So this will be the determining factor if you realize the benefit of being a day trader or being a long-term trader. This is the lifestyle of a long-term trader. And this is a day trader's lifestyle. I'm going to sift through all of that information, which it is not, it's very time consuming. So I just want to make sure that you guys fully understand that. So, with all that being said, you understand that the higher time frame will allow you to realize more profit. All right? Profitability is very important. I want you guys to know that. That's where it's at. If I want to be your mentor, I'm going to show you the best ways to make the most money. Not those ways that I can keep you guys as a student. I would love for all of you to remain a student. Trust me, I would love that. But I understand that everyone doesn't need years and years of training in order to master something. You got college grads, they go to school for a number of years and then they're done. They're a master at their, of their trade. They don't need continuous schooling, although a lot of times they do go back as a refresher. As a trader, you will have to do that. You have to stay up, on top of the studies and back test. That's your way of studying. That's your way of going back to school, going back and back testing. So I want you guys to understand that as a day trader, really think about your type of trading that, the type of trader you want to become, the type of trader you want to become. And I'm hopefully I can show you guys the profitability with being a day trader, a long-term trader. Just a quick example, something that jumps out at me right here is the fact that if you look at this, you have an engulfing candle at the top of a move. And if someone would have seen this great pullback, engulfing candle, all within one day, the market went up as if it was going up like any other day. It was running up consecutively. So today was no different. This day was no different. It went up. But then, guess what happened? Guess what happened? It pulled back, and then it went back south. So at one point, this was actually a bullish candle. And I'm going to tell you why it wasn't all too favorable. If I was trading this going up, I would have known to get out of the market. I traded this going down and got out. I think I got out. There was a long, this one. I got out here. I got out pretty early because there was a long pullback. So if you had traded this going up, these two candles right here would have been your reason to get out. All right? You have hammers right at the top. You have to be careful with those on a run going up. This is price action, by the way. Hammers, and then you have a great pullback, and then you have an engulfing candle. All within one setup. Clearly, the market is going down, and it went all the way down. 2,000 pips. Crap. Screw the retraces. Those retraces are petty. Yes, I did get out here, but this isn't my pair, so I don't know this pair like the back of my hand. So I got out here on the clearest indication that the market will go the other way, and it did. But nonetheless, this market here, this right here was a clear signal that it was going down, and you could have gained all of that. Now, granted, if you looked at the hourly chart, it would have shown you something different. You probably would have seen that you probably would have seen the pullback, but you probably would have seen it. You would not have seen the big picture. It would have given you 1,000 candles, but not the clear picture as looking at this. The market came all the way from here. It went all the way up to there. So this was a nice signal, and for those who caught it, they ran the market down. And these setups happen all the time. You just have to catch them. Don't be in a race. Don't be in a race to make money. Let the market makers and big banks show you the way. They want to show you what's going on. Don't rush it. You know, their job is to fake people out. But ride their coattail. Wait until they show their hand, and then you get in and follow them. Here, market went sideways. Engulfing candle going up. The market went up. All right? Very clear what was going on. After this engulfing candle, it rode the market up as high as 700 pips. Then signaled ride it down, 2,000 pips. So these signals on the daily chart are very powerful. They're very powerful. So so now let me 1 second. Let me go to my other system. So I want to make sure that you guys understand the. I wanted to start off this training with portion of it just to go over like day trading versus long-term trading. Very important, because that's what's going to set you guys apart from making, $50 a day to $500 a day. Woo! It will. It certainly will. So you can simply make, let's say, depending on when someone might be available, you might engulfing candle on an hour. You might trade this going down. You might make 30 pips there, but look, you would probably shaking your boots there because the market was going up and down, long wicks on both ends, but it finally went down. So you could have made a pay 30 pips. But if you had gotten in, well, let's say here, this is where everything started at. If you had seen this, you could have made engulfing candle down. You could have made 100 pips, and then you would have been thinking, okay, I guess it's going to go up now. Well, you'd have been faked out because it's still going down, and kept going down. But on the daily chart, it was just going down. That's all it was doing, going down. So want to make sure that you guys understand is how important it is to trade on the higher time frames. Don't be faked out trading on the lower time frames. The lower time frames is nothing but a fraction of what the market is really doing in its entirety. All right. So I want to make sure you guys know that. Make sure you're looking at the hourly chart. The daily chart. Make sure you look at the daily chart. The daily chart. If you are a short-term trader and you trade the hourly, do what you do. But I just want you to know that it comes with a little bit of risk. All right. So I want to make sure that I'm clear about that. So let's I'm going to now get into, and it's the reason why I started off this way. If you were coming into this training, if you considered yourself a day trader, if you can type in yes. All right. Looks like Okay, it looks like we have, a number of day traders. Okay, all right. So let's so you guys understand that being if you're a short-term trader, of course you're getting in, you're getting out. You have to watch the charts more often. So that's something that you must consider. All right, as a trader, and I definitely understand that a lot of you are probably fighting with the idea, or just fighting with the fact that if you're working, you might not be able to look at your charts all too often because of your obligations at work. That's more of a reason to be a long-term trader. All right, long-term trading is definitely by far it's less stressful. It's for those of you that are coming from binary options or anything like that, you understand the stress involved with trading binary options. You don't even have to worry about that when you're doing long-term trading, because if you understand when to enter the market, everything else is profit. All right. You just have to know a great volume size and that's suitable for your account size, and that's it. So I started off with this topic because I want you guys to see the difference between if you're trading as a day trader or trading as a long-term trader, what it will mean in terms of having your support and resistance lines spotted on your chart. All right. Now I'm going to start with a short-term trader or a day trader, what they would have to go through. Just going to show you. I'm going to do this. I'm going to do this off of the. Let's go with the GBP pad. So, looking at this, there are a lot of different levels. A lot of different levels in here. And, if I had to plot them on, which I will, it could become a little noisy. So just to let you guys know, when I trade any chart, I'm always looking for the highest spot and then the lowest. And sometimes, based on the chart, the current price action, it might be enough because, sometimes just the way that the temperament of the actual chart, it could be a little misleading. Sometimes you have to look back far enough to see, and so make sure that you follow a certain I tend to look for the high and the low and fill in the middle. So when I look into this, I'm looking for, I can do that. All right. And I like this because the market came to here and backed off. It came to here and backed off. It went all the way up and pushed back down and backed off. So this is a great level. All right. Now what I do is I check my level, draw my line on, and I look left. And when I look left, you see that the market has come here and bounced off here. This is dating back 10 years ago, 11 years ago. See that? 16 years ago. All the way back to 2000. So we know this is a good level. Now, mind you, this is the daily chart. So I'm going to show you the daily first and not the hourly. All right. Now what I'm going to do with this, I'm going to draw one down here. I'm going to do one here. This is a great level too. All right. And I'm going to look left. Normally when I do this demonstrations, In training, I normally change the colors, so I'm going to follow the same routine just to be sure that I'm looking at the right one. And we see that this is the last time, which is 6 years ago, that it touched. So this is a good level. So we see all this open space here. Actually, I'm not gonna go ahead. Let me just draw my lines on. So now I'm gonna go with the obvious. What I like to do is when I see the market go up, hit a level and go back down like this on a daily, I usually make that a level. Not the itty bitty ones. I'm talking about the nice big ones. You know, that's a level. Like here, this will be 1, 2. It's pretty much in line with this one. But like something like this, these, you know, but they're all in line. This one, I would use this one, you know. Sometimes I even use my crosshair, so you can use that level there. You could use this. You could, you know, it's a swing scale, this one, because of this little peak there. But trust me, when the market gets to this, if you drew a line on here, if the market gets to that level, then you can adjust it accordingly. But just for the sake of demonstration, I'm going to put one on there. You see it touch there, a couple times there. Great level. This is a good level. So although it's higher, it's still a good level. Definitely put one here. This level is outstanding. And if you notice, I'm going with the level that's most obvious. I see that the market has danced around this level. Sometimes you may have to use your crosshair if it becomes a challenge. Use your crosshair just to eye it up. You know, I can put one here. So that's what I do. Make sure you draw your lines on, and you want to start with your daily chart. Make sure that you write that down. Start with your daily chart. Your higher time frames will always guarantee or give you that they're going to give you the best levels. And the daily is always a plus. It's right in the middle of the, you know, of everything. The monthly, of course, you're going to get less levels, but they're going to be strong levels. The weekly, a notch down. The daily, right in the sweet spot of everything else. You can drop down to the 4 hour. I normally use the daily and the 4 hour for my support and resistance. All right. So let's draw on some more lines and let's follow this routine that I'm on. Let's go with something like this. I'm going to use that one. That might be maybe not as strong, but this is good. That's good. And I'm going to actually look back left and make sure that these levels, as you see, they're good. There are good levels. The purple, that's a good level. This top one, let me change this to a different color, maybe like a lime. Let's go with a different shade of green. Let's go with regular green. We look left, see that this level, it isn't bad. It's favoring a good level. Probably one of the weaker levels, but it's still a decent level. So basically, once we draw our support and resistance lines over, as we have it here, I would want to put one. I would definitely put one here, without a doubt. this was the Brexit news release, and it went all the way down to this level. So that's a very important uh, area to watch, and that's actually very good. The market has gone down since then. So we check to see if this level is good. Right there, that's good. You see, bounce off that. So this is a good level. That's a good level. And see now, I'll put one there. Let's go with regular blue. Left. Got some consolidation there. Tapped off there. Tap there and right down. So we see that this level is good. Now, you might want to write this down. Actually, I would love for you to write this down. Please write this down. What you want to do is you want to make sure that, just like I'm looking back left, make sure that that level has been touched. I would say, you know, if you can find a level that's been touched 2 or 3 times, or possibly more, that's even better. I like to find levels dating back years because I know that these levels are strong. If I get the market come to a level in the present that was respected in the past, then I know that that level is good. So let's look at what we have here. It looks like we could probably put one there just to watch it. This might not be the best level, but I want to watch this level because the market has come here and now it's like it's ready to turn around possibly. So it could turn around. So let's look for the orange. And we see we do have the orange is actually respected, which would be a good reason to probably take your money, take profit rather. And all the way down to here, bounced up. Now, the reason why we haven't figured this out yet, the reason why we plot the support resistance zone is that the support resistance will be your turnaround points in the market. It will be your points in the market where you take your profit. It will be the points in the market where you think or you expect for the market to go for you to get into the market. For instance, I am currently in on this trade right here on the GBP pad. I am in on this trade right here, took it from here down to here. So with that being said, looking at the closure of technically yesterday's candle, it might behoove me to get out, but I might want to wait to see what this candle does up until the wee hours of the morning. So what I would probably do, if this candle does go up, I would take my profit at this level. All right. So basically, when you draw your support resistance line on, as the market is going up, you have an indicator or an area where you know I can take my money here, and I can wait to see if it breaks this level or bounce off this level. All right. Because the market, as we know it, you only have candles that go up and down. So that you have the market going up and down as if all you have to do in this trading arena, all you have to do is figure out if the market is going down, where is it going down to? Once it plants its foot, you know it's going to go right back up. Wherever it stops at, you know it's going to create a resistance, and you can expect it to go back down. And expect is the key word. Nothing is guaranteed, but you have to make sure that you have the confirmation. So let's go back. Let's go back. All the way back. We know now that support resistance are the sweet spots in the market where are the sweet spots on our chart where the market is likely to turn around from or bounce off of or run to before stalling and then realizing if it's going to go up or down. All right. On a lot of these levels, you will notice that the market has traveled to these levels that I have plotted on, and it either bounced off of it, went sideways. I mean, that's all the market is doing. It's going up and down. And if you have the best, well, actually, let me put one here. About that. If you have great support and resistance levels on, trust me when I tell you, you do not need to know all that they teach online and these other groups and all that stuff. You do not need to know all that stuff. I'm trying to tell you, the market is only going up and down. And the market itself will always go to a support level and it will always go to a resistance level. So if you have your support and resistance levels on your chart, there's a great chance that you're going to always be at the front of the move. For instance, and I'm going to throw this out there to the entire group, everyone who's listening, everyone who's watching, I want you guys to know this. If I'm in on this trade right here, and I see that I have my support level plotted on, and if I realize that this level is a strong level, because the market, not only, let me zoom in. The market has traveled down to this area. And if I want to take my profit, that's because I am, without a doubt, sure that the market will most likely go back up. But you know what? Even if you're 90% sure, even if you're 100% sure, that's just in your mind. You're not guaranteed. It is not guaranteed to bounce. But the reason why we take profit at our support and resistance is because, one, you want to always close out your money. You do not want to leave money on the table to be taken away from you. If I'm riding the market down from this consolidation down to here, why would I wait for the market to go all the way back up before I realize, oh, it's going up? I will rather take my profit here, just take it. Once I realize that this is a strong level, I will take my profit here and then allow the market to show me which way it's going to go from there. Now, that might not be your routine all the time. You might not always take your profit. I have accounts that I let the market run because I know that I have enough capital in there where if I'm in on a sell and the market is going down, I can absorb all of this. I can absorb a few hundred pips going up because I know eventually it's going to go back down. So that's where I want to get you guys at, to the point with your account where you can withstand the market going against you some, but knowing how to, but also understanding where to take your profit, where to get in at, and all of that stuff. So if you have a good side account, you can withstand all this. Doesn't mean you have to do it. If I choose to have the market go against me, that's my choice. You don't have to do it. I'm showing you the way that will make sure that you're growing your account. This ensures that your account is always growing. Taking profit at the support or resistance, and then waiting for the confirmation to go up or down. Do that all the time. That's what you want to do. So, as I said, let's go back to this area. I'm in on this trade. If I chose after this market, after this session goes, to close out the trade, if I chose to close it out, then you know what? That's on me. That would be I'm protecting my money should the market go up against me and we are out of the moment. But this is my money. If I wake up and the market has gone up and it has engulfed a couple candles, that's enough room for me to believe that it's going to continue going up. But however, if I wake up and the market has fallen through this support far enough where I feel like, you know what, I think it's going to keep going. Maybe I should get back in. That's where you have the luxury of getting back in. But look, you've taken 500 pips of profit. You don't have no more money on the table. So you can easily, after you take the profit at support or resistance, pop in another trade and let it run some more. If it shows you that it's going to continue to run. Now, those of you that know I trade the GBP NZD, that's not fair. Let's go to the GBP NZD. And I'm going to show you guys some things that, let's see. Okay, here we go. So let's look at this. We're on a daily chart. So currently we see that we have, I want to draw these on real quick. Just let me draw these on. Just give me 1 second. Let me just draw these. I'm just going to draw some more so I can make my point and go back to where I was at. Now I'm putting these on because I know this like the back of my hand. I know what levels are strong, what levels are not. So let me just draw these on and I'll be right with you guys. And yes, when you join your lines on, you should always be looking back. Because I know this like the back of my hand, I'm not doing it. I know what levels to do. So let's all right, so we have our levels drawn up. You guys then took this trade down in April 2015 and rolled it up to September 2015. I took this trade along the way, not the entire thing, but I closed out, opened up. I took probably about 65-75% of this trade out. We noticed that the market's consolidating at resistance. If you guys do not know what consolidation is, you're going to soon find out. A very powerful indicator of something about to happen. That's what it is. When the market moves sideways, expect an explosion of some sort. All right? The market did not break this level. Do not mind this way. This was the result of the Greece situation on August 24th of last year. So do not mind that. That same wick you can find on a lot of GBP trades. Matter of fact, like this one. Or like that's the 24th of August. So do not mind that wick. That was outside of balance. This was the normal move going up. Now, yeah. So after the market pulled back down, it kept going. All right, it kept going, and then it started going sideways. If you had seen this trade, if you had your lines drawn on, in which after a couple of days of the market going sideways like this, when it came up to this level, it came back, I would have immediately put my line up here, and I would have looked left. And let me just show you guys what left looks like in this particular pair. This is left of that. We're talking dating back 8 years ago now. Dating back 11 years ago. So we know that this is a good level. So if I was trading this going up here, there's no way I could not have seen this. Which is why when I saw this, have a line there, and I threw the market down. Having this level here would have been a clear sign that the market was going to go down. All right. Let me explain to you guys how support and resistance work. Support and resistance is nothing but the floor and the ceiling. All right. And what you want to keep in mind when you're trading is that there are different levels. Those of you who might live inside of a multi-level home or an apartment building or a condo development, you might have multiple levels. It doesn't mean that each level is as strong as the other. They should be from an architectural standpoint, but it doesn't necessarily mean that that's the case. But let me explain to you what happens. If this is your roof, and if you drop the cannon through the roof, penetrates the ceiling, goes to the floor and ceiling, goes to the floor and ceiling, and it stops. Well, that's the reason why it stopped here. Well, rather if it's because of it's losing steam as it's going down because it had to penetrate through different floors, regardless, it stopped at this level. And why didn't it stop at these levels? These levels are probably not as strong. All right, it stopped here. So this would be the equivalent of something like this. This bears a level 2. So from here, it shot up. It only ranged after this, but after the range, it shot up. All right. So there's a reason why the cannon would stop at this level, and that's the way you have to look at it. Your levels are meant to be broken, but if they're not broken, Forex logic should kick in, and it should tell you, well, if the market is dancing around this level and not breaking it, well, instead of me being at a 50% chance of winning my trade if I put a sell in, I would think that I'm probably at more like a 75% because I'm going to put more weight on it going down. I'm going to put more emphasis on trading down rather than going up. There's a higher probability of it going down because it's not breaking this level. So that's the mindset you want to have and take on when you're trading. Look at the market logically. It's logic. If you go down a road and you got potholes all over the street, if you go down a road after it snows and the salt pan is out and you get potholes all on your neighboring streets, well, chances are that's just going to be the way that it is. So you probably want to get out of that neighborhood. Well, same thing. If the market is going down and if the market is holding steady here and it's not breaking it, well, chances are it's not going to break it. This tug of war match is telling you that, hey, the buyers isn't budging. They're getting weaker and weaker until the bears take over. So you want to really think of this whole buy and sell fight that's going on. You think of it like a boxing match. Seriously, think of it like a boxing match. Two opponents in the ring, they're slugging away at each other. One is blocking while the other one is wailing away at him while he's against the ropes. At some point, the boxer who's slugging and taking all and throwing all the haymakers and uppercuts, he's going to get gassed out. And while his opponent is against the ropes, blocking away, protecting his body and his face, eventually he's going to know when to reverse the situation and get away from the ropes and pin his opponent against the ropes so that now he's throwing the punches. He's in control. And that's what you have nothing more than ropes, levels that the market is bouncing off of. So which way are you going to trade? If you see that the market bounced off this rope, didn't break it and keep going, chances are the rope is going to reverse and it's going to go down. If it bounces off this level and it doesn't break it, logic will kick in and tell you that it's going to reverse and go back up. The key is realizing when to get in. That's the key. Forex is very easy. It's very easy. It's so darn easy. The problem is the problem is people make it hard. Do you guys know that people do not want other people to know how to trade Forex? Some people would rather you guys lose. I want you guys to win. I want to give you all the tidbits of information because I want you to honestly win. I get a joy out of getting emails from you guys. It makes me feel good because I know that I'm doing this. I'm doing this for a good cause, and so it makes me feel good. So I want you guys to know not everybody has the same stance on their team. Not everybody's like that. Some people just want to give you just the bare minimum. Yes, knowledge is power, but you know what? I look at it like this. The world would be a better place if everybody had the same opportunities. So, I think it's very important that you guys understand the logic behind Forex trading. Don't get caught up in all the technical things you want to throw, all these indicators on your chart so that you can, look like to the person walking behind your computer screen like you're this, computer whiz. Scratch that. I don't know, cuz I don't know him. I don't care what he thinks about me. But I know my charts. And that's what I want you guys to be confident in your trading. Do not worry about stuff that has no relevance on what's going on. Like those indicators, RSI, MACD, Bollinger Bands, can they help you trade? Yes, they can. I will not deny it. They can help you. Are they accurate? No, they are not accurate. Are all indicators accurate? No. So you know what? You focus on those things that give you the most accuracy. I happen to know, and the way my strategies happen to be very accurate. Because I don't need a Bollinger Band. I don't need Fibonacci because Fibonacci is I make my own Fibonacci. That's what you're looking at right here. All Fibonacci is nothing more than support and resistance for some based on a mathematical equation of certain levels and this and that and that this and who cares? Draw your own on your chart. Draw your own on your chart. When you draw your lines on your chart, that's what you're doing. You're tricking your mind. You're believing in yourself. Not some equation that had nothing to do with you 10 years ago. Draw your own lines on. Keep it simple. I'm telling you, keep it simple. You want to keep it simple. You don't want to, have too much stuff on your chart because then you can't focus. So, support and resistance, very powerful. If you're in, I'm going to tell you guys this. I want you guys to write this down. Write this down. You should only be trading at two areas. Two areas of your chart should you ever have to trade at. Can someone please tell me what those two areas are? Thank you. Thank you. Thank you. A lot of people are getting it. A lot of people are getting it. Exactly. If you only traded at support and resistance, if you only traded at support and resistance, you cannot lose. You cannot lose. You know why? Let me explain to you why. We're going to do the math real quick. I love math. I love numbers. Keep it real. We have $1,000 in our account. What do I say? Keep 1,000 pip range, right? So you keep a 1,000 pip range. So you're trading at $1 pip. All right. Yeah. So you're gonna trade at $1 pip. All right. That's not really what I wanted to do, but no, that's not what I wanted to do. So you have $1,000 in your account. Let's just do this. Let's do it this way. And mind you, we're not talking about the hour chart. Get the hour chart far out of your mind. I want you guys to focus on the daily chart. If you don't want to focus on the daily chart, then that's okay. But I really want you guys to, I really care about you guys winning, so I want you guys to see the benefit of this. So look at this. You're trading at $1,000 a bit. So you have $1,000 in your account. All right? And you're trading the day chart. Remember, anything can happen. But you're trading based off the tools provided through the Sold Out Easy Forex movement. So you know that, you know what Mr. Scott said, I'm only trading off of support and resistance. And if you have your true support and resistance plot on your chart based on your daily chart, your chart should look something like this. You might have a few more if you drop down to 4 hours, you put one in here. I'm going to do that. Put one in here. Probably put one in here somewhere. Yeah, so you do something like that. So you have $1,000 in your account, and you know you only trade off support and resistance, and you saw the market, it came up, and it's at a level. Let's say it's this candle right here. This candle right here. The market came up to this candle. I'm sorry, this candle came up to your resistance line. You already have it on. If you saw this. All right, so you already have it on. So you know that this is resistance. So what's going to happen? What should kick in first? Oh, you know what? That's resistance. You know what? Let me watch. You're not in on the trade. You're just watching the market ebb and flow up to your resistance level. The first thing you think is, okay, is it going to break through or is it going to bounce? You don't know. But guess what you do? You wait for the signal. That's what you do. Wait for the signal. So the signal comes the next day. It comes to the same level. It pierces it, but then it pulls back below it, which is another signal that it's a strong level. That gives you a little bit more. That puts a little bit more emphasis on. I really need to watch the pull below the level that I realized was just. Now I'm really thinking that this stuff. Then the next day, guess what happens? This candle opens up, barely goes up, goes south. I understand that if the market was here, like half the candle, most of you probably would have gotten it. it happens. We might get in premature. The conservative way is waiting until the candle closes, allowing the confirmation to complete itself. If you're trading off the daily chart, you're getting in before it closes. Yes, you can get a 50% odds of winning, of being right, but at the same time, the confirmation isn't complete. So if you wait till the candle closes, guess what? Let's just act like this. I just put this here. Let's act like this isn't even here. But you could have rolled the market down from here down to here. 813 pips. And it's as easy as that. Because once you get in and you realize the market is actually going down, you might have some time in the market to pull up against you. Don't fret. Don't worry about it. Let me tell you why you shouldn't worry about it. Well, the market pull against you, I don't want you to just be careless. I want you still to have an exit strategy. But I want you to know that when you're trading off of a strong support or resistance, you're at the front of a move. All right? And chances are, if you got in, let's say you took this market up. Let's say you ignored my rule. You ignored my rule of the market being at resistance. And you kept, let's just say you had a buy going in. Let's say you had a buy in. Well, let's say you got into the market and you saw it cross over your resistance level. You didn't wait for it to close. You got in prematurely. Let's say that. You got in the market, and this will happen to you. You get in and the market pull right down. Like as soon as you put your trade in, it'll pull down. Trust me, it's all done. So you're now up here in the market down here. So now you are out of the money. 120 pips. Let's say 120 pips. You're trading at $1, right? You're $120 out of the money. So right now you have what? $880 in your account, roughly, give or take, right? But now when the day closes, you realize that it closed below your resistance. So now you start to really put the big picture into perspective. You're like, you know what? I got it too early. Mr. Scott said don't do it. Or Yusuf said don't do it. He said don't do it. He said wait until it closes and the confirmation is complete before I get in. And I got in too soon. I was anxious. I want to make some money. But it's a $120 lesson learned. So what do? You close out your trade when you realize that it revealed that this was a sign, this level was strong. So now, let's keep that in mind. You are now a negative 120 in, you're a negative $120. All right? You're out of the money at $120. So now you're at 880. But guess what, Mr. 880? The next day, the market pulls down. And guess where you're at? You're at resistance. Guess what else you have? You have a classic setup. You have a nice pullback, back below resistance, and golden candle. If you close at this point, if you got in when the market closed, you could have rolled the market from here down to here. And that would have been $800 more in your account. So it'll wash all this out. So let's do the math now. Let's do the math. You started off at 1,000. You lost 120. You're at 880. You gained 800. You got 1680. You've almost flipped your account. Almost doubled your account. So that's a nice profit. You know, you're up 60%. It's not bad. And that's all because you follow the rule. You would have been $800 in the money had you not got in before you were supposed to. A $120 lesson learned. These hard lessons, these are hard lessons, but there are lessons learned. All right. Now, same scenario. Let's imagine you weren't trading at the dollar a pip. Let's imagine you were trading too heavy. Say you were trading at $5 a pip. Do you know what $5 a pip would do to your marginal percentage? Do you know what it would do? Let's just see. Does anyone know what it would do? Does anyone know what it would do? Just curious. All right, bingo, bingo. It will decrease it quite significantly, might I add. So if you're trading at $1 with $1,000 in your account with a 1,000 pip range, give or take, it will be a lot more than if you traded at $5. Basically, what you're telling the market is, hey, if I put this trade in here, and if I walk away from it, the market can go literally all the way to here before I get stopped out with margin call. Versus, hey, I'm going to trade at $5 a pip, and that's going to give me just that, 200 pips. I'm out of the market. Now I got to work a couple more weeks or whatever it might take to get me back into the market. You do not have to trade heavy. Trade off the daily. Get in at the best times when you have a confirmation. Everything else is history. If you get in too soon, do not wait too long before you realize that, hey, it's not going up, it's going to go down. Just as I was expecting it anyway. Whenever the market goes towards resistance or support, your first thought is to expect it to bounce, always. But you do not trade off of that expectation until you get the confirmation. So if the market was moving up to here, I'm not getting in on I'm not going to get in on a sale just because it's at resistance. I'm going to wait until I get a confirmation. The first confirmation may have been the pullback, but the ultimate confirmation was the engulfing candle. The market sold it off. So remember, you're only trading at 2 points in the market. At support or resistance. Let's say support and or resistance. The only 2 times I want you guys to trade. I know that there will be people trading whenever they want. But I'm gonna share something with you guys. I traded, I don't know if you guys have seen it, but I traded the Euro NZD. Had been in a trade for a couple days. And yesterday, with all that I had going on, running around getting things done, over the last couple of days, the weekend, whatever you want to call it, earlier this week, I had realized that I was exhausted. I got up about 2 or 3 in the morning, realized that my trade, I had put in trades at the top, put trades in like midway, were really about 40% down, and then I had it running, and it was at a level. And what had happened was, let me see if I have it here. What had happened was the market had presented a bullish candle, and it had gone up when I went back to sleep. But when I got back up, it had already pulled back down to get back in the profit. But had I got in, I did get in at a good time. I put more trades in, but I didn't do it. I put it in too late. It was probably too close to support. And when it finally started going back up. It pulled me out of the market for a second. Luckily, when I woke up, I was back in the money, and I closed it out. It was a good day. But that's another indicator there that will tell you you're in at a good time. Your entry is key. It will be the factor. It will cause you to be a loser or a winner. Get in when the signal is presented. You will be at the forefront of a move. Forget trying to get in right here. I want you guys to get in at the top of the confirmation. Right here. You didn't have a clear, even this engulfing candle wasn't expected. It went back up. So we were in a noticeable consolidation or a tight range or whatever in this area. It wouldn't break it. But it finally broke it. And when it did, it went down. It kept going down. This is where it is now. So it's very important that you guys understand it's important that you guys understand the power of support and resistance. It's a reason why these levels they run to these levels that it ran to in the past. They are very key levels. And until you realize it, you will find yourself fighting against the market. You don't have to. Why fight those who have the power to push the market around when you can ride their coattail? You're shadowed. The big banks and the market makers, they will leave clues behind themselves. When the dust settles, pick up the pieces. Take who to work. And then realize like what to do. Very simple. All right, so I'm going to go through some questions real quick, and I won't go through all of them. We'll start at the top and work my way down to the current. So if you have questions, we'll put them in now. I'm gonna touch on some of them. Some of them I won't. If I touch on them, then I deem it necessary to question. Some of them I'll probably just wait until just let you email me. So let's see. I'm gonna answer the questions. I'm gonna read it out and I'm gonna answer the questions that I think are very common questions. All right, so just give me a second. All right, so we had someone ask, once you take a trade on a daily chart and you're away from your computer, how do you know to get out of your trade? Price action. Price action will tell you. And what price action is nothing more than a series of candles or formation of candles that indicate the market move. All right, each of you should have received the candlestick cheat sheet. I am working on, just to let you guys know, I am working on a second edition to that, and also a second edition to the So Darn Easy Beginner's Guide to Forex Trading. don't want it to be so much. Well, actually, I'm actually writing a book that I'm working on getting published, but I don't know if I'm going to have a smaller, like a PDF version of it, or if I'm going to just go get the publishing for it, hardback or softback. I haven't decided yet, but that's what I'm working on now. But of course, I'll make sure that you guys definitely have that. So, but that cheat sheet will definitely give you insight on what the market is doing. One thing for certain, and I'm going to make this clear, you want to make sure that you understand the reversal setups, the reversal candles. Reversal candles, all too often, are painted on the daily charts. And they will be your green light to making some money. And sometimes it's so clear what the market is going to do, like this. Engulfing candles, there's no other way but going down because we're at resistance. So sometimes it'll be so clear, and it's like, are you serious? Like they would really leave that wide open like that? So that's why it's important that you understand price action, because aside from knowing support and resistance, support and resistance is like is key. It's key to you making profit, because it stands between you getting in early or late. So support and resistance is key. But then afterwards you have price action. Price action happens all day long, but it's the proper price action at the opportune level that will indicate big move or don't waste your time. So this being a major level, supposedly, price action signal, big move. 4,000 pips since May 31st, since June 1st. I launched the website this day, June 1st. It has traveled 3,500 pips since then. A subtle retrace. I mean, that's nothing. That's whatever. I mean, but it just goes to show the market can move, and it doesn't take long, especially on the GDP and GDP. So let me go back to the questions. All right, so let's see. I kind of tied in a lot of stuff into this all in one, so we're actually making good time. Let's see. Yes, exactly what I'm showing you guys as far as putting on support and resistance, and then checking for price action. Put on your support and resistance, check left. That's the way I do it all the time. I would never do it any other way. In fact, when you guys become good at it, you guys will see a level. Like the more you do this, your eyes will become trained to see certain things. Like for instance, yesterday I pointed out oil. Oh, sorry. I pointed out oil yesterday. And yesterday the market was this candle, not yesterday as in yesterday trading day, but yesterday as in Wednesday. The market actually was down here. And I see the pattern. It's literally going up and down. It's like, come on now, who can't see that? So I made the call. I said, listen, I was going to put it out there to the group. And I told you guys, look, y'all might want to get in on oil, because I saw it reaching this level again, and I was expecting it to bounce go up. All I was alluding to it going up. I didn't say go up. But if you read into the verbiage, you would have known that it's an indicator of going up. I was indicating market going up, and a number of people that I've talked to since yesterday, uh, really impressed me with their trading on that. I mean, it really hammered it up, and that was a great call. And you had to catch it right when I put it out there, because not long after I put it out there, the market went up. It went from literally being bearish to being bullish, literally. So, and that's just me opening up the charts, glancing, and saying, all right, let me see what I see. What can I see? Oh yeah, I see this setting up. Oh yeah, I know what it's going to do. This thing's going up, and that's what happened in the same day. It wasn't the next day, in the same day. So, eventually you're gonna be able to see the same type of setups without having to really try. You don't need to do much to see these things. So so let's go back to the questions. Just bear with me, everybody. This is what this. All right. All right. One of the questions was, is there a rough indication of how big a pullback we should expect when we are riding down to the next level? Just to have an idea when to sit tight and when to exit. You know, one thing that I say about trading forex is that everything is, because the market fluctuates so much, even me giving an average, it's not even accurate. It's not even accurate, because there's so much fluctuation, and so I wouldn't even really consider that. I couldn't say that. The only indication of, I would say this: if there's a pullback, the pullback itself is enough for me to know that I need to, get out of the market. All right. So, and I hope I understood you clearly. But from what I believe you're saying, if the market's going down, if it's pulling back, how far? I just happen to, when I see the market reach a certain level, it's like the forex logic kicks in, and when I see the market pulling back, I know that there is a reason why it's pulling back. It's some support down there, or it's resisting that level. There's something going on. So you just have to be careful. You have to just close out your trade, because if you're in a provider, you're in the money, then yeah, you could, but just to be straightforward with you, price action would be the best indicator. It really will. No moving average is going to tell you that in one candle. Price action is going to be like the best indicator, because you can get the market pulling back. It can be pulling back, but then the next candle opens and it push back down and fill the weight. So I would definitely let price action just, give you the realization of what's going on. All right. One question was, what are the best trading times and pairs for a beginner without becoming overwhelmed? All right. Great question. This is one that I'm sure a lot of you have asked before, and a lot of you are probably wondering. As far as pairs, if you're a beginner trader, I would have to tell you to focus on the pairs with the smallest pip spread. One of them would be the Euro USD, very liquid pair. You notice the pip spread here is very low, just under 2. All right. So I would have to say, focus on, if you want to focus on the Euro USD during certain times, the Euro USD might be, a little over one pip, pip spread. Almost like as soon as you put the trade in, you're like almost into the money. So I would focus on those pairs with the smallest pip spread. All right. And if you do not understand what the pip spread is, when you look at your trade panel, all right, sometimes on certain charts it might be hidden. This little triangle pointing upward, as you see when I hover above it, it says high trade panel or Alt T. And when you click it, it's revealed. Or you can just use Alt T. Real simple. All right? But you use this to show you the pip spread. And basically, the pip spread is going to be the difference between the two. All right? So you want to make sure you know that, for instance, I trade the GBP NZD. The GBP NZD has a pip spread of usually like 6, a little bit over 6 or so. So if I'm trading at, let's just say I'm trading at $10 a pip, I'm going to be $60 out of the money, and I got to wait till they get back into the money to realize profit. So if you're trading at 10 cents here, you'd be like 20 cents out of the money. Yeah, you're not risking a whole lot, but you're not looking at making a whole lot because your volume is low. So that I would suggest you finding the pairs that are low on pip spread. The USD JPY is one of them. Euro USD. In fact, I don't trade a whole lot of pairs. I keep things very simple. Like I tell you guys, you really want to focus on, maybe 1 or 2 pairs and keep it like that. Master them pairs. But to answer your question, you see US CAD. This is not bad. I mean, US CAD is actually a nice pair to trade, believe it or not. It does a lot of ranging and stuff, at least for the last couple of years or so. The last couple of months. I would have to say just stick with those with the smallest pip spread, and then let me go back to the question. There was the second part. The best trading times would be during the London session in New York. I do not trade during this time of day. If I have trades running, I'm not trading. So anywhere from 2 or 3 o'clock in the morning, 2 or 3 a.m. Eastern Standard Time, all the way up until maybe, really, if you're just getting into the market at 1 or 2, unless it's FX, FX, unless it's like the FOMC, I would probably just not even trade that day unless you just have to see what's going on. But the FOMC normally happens, 2 o'clock, and you can get some very good moves off the FOMC. So, but I would, generally speaking, I would say anywhere between, you have a 12-hour run, 2 in the morning, 3 in the morning, up until 2 in the afternoon, 3 in the afternoon. After that, it's like, why even get to the market? Not saying you can't, for those who can only trade during the late afternoon, early evening session. It's not that you can't do that. All right? How many pairs do I watch? How many trades per week on average? That really varies. That varies. It really depends on the what's going on in the market. I don't want you guys to understand this. I get a lot of questions about, especially when people are onlookers, people are looking for, like, is this so slow down even before it's moving, if it's good, if the strategy works or not. And they ask questions about the average. And I tell them, I'm not going to give you no figure because that figure becomes fixed in your head. And if it's fixed in your head, you're going to look at making that number. And if you don't, it's going to it's going to be mental. To do mental things to you. You'll think you're not a good trader. You're going to think that you got to trade a little heavier to make a little bit more money to keep up with my average figure. So I'd rather just say, in terms of the pairs that I watch, I probably watch, let's see, probably about 4 or 5. But really, my main target is always the GBP and BD. I'll look at a lot of different pairs, but I'm usually, I have probably about a handful that I'm looking at every day. But I don't necessarily trade them every day. So whatever amount of trades you can take a day, that's what you take. Don't worry about whatever, oh man, everybody over here trading 30 trades a day. Don't worry about that. This is no race. We're only in a race when you're on a racetrack. This is no race. You know, you can make money, gradually, or you can quickly lose all your money. Just do what you can do at the pace that's comfortable for you and go from there. That's my best advice about that. Like I said, okay, the times that I check my charts between the same time frame between 2 and 2, I'll say that. I do not use a stop loss at all. Let me explain to you about stop loss. Why I don't use a stop loss, and then we're going to get back into. I will come back to the question. We'll get back into the actual training. One thing about me is this, and I want you guys to really understand this. The market has a way of knocking people out. All right, and there are tools built inside of this platform that will expose you. While you want to be discreet, you're walking around with a target on you. I choose not to do that, and I choose not to trade with a stop loss. However, I'm not telling you guys not to trade with a stop loss. This is my theory. In fact, I have a video inside of the back office that explains how to set up a stop loss. So I'm not telling you guys, I'm not trying to persuade you not to use stop loss. It can be very helpful, especially if you're the type to walk away from your computer often, or you're a short-term trader. When you're trading, you want to make sure that you're not leaving yourself open. Whether or not you guys know, when you trade too heavy, just because, let me say this, based on your account, if someone can see your stop loss, and that's why you're stop hunters, that's why that term is so valid, then don't you think they can see that you're trading too heavy? If you're trading, how many times have you guys, and I just want to see who says what. How many times have you guys put in a trade just to right after you put in a trade, the market goes against you? How many times have you guys done that? Like immediately after you put in a trade, the market goes against you. And let me ask you this. How many of those trades Were you trading heavy? Let's say too heavy, or let's just say heavier than what I would probably suggest. Let's say that because there's a a very a slide scale on that. Okay, all right. It's definitely a mixed bag. Let me tell you guys, you guys have to learn that. Let me see. If you're at $1,000 and your goal is, let's just say your goal is $100 a day. All right, your goal is $100 a day, and you make $100 a day. I'm sorry, 100 pips a day. You make your 100 pips a day. So you go from 1,000 to 1,100, and then what if the next day you increase your volume ever so slightly to maybe to maybe uh, $1.10, $1.20, and you trade $1.20 at these times that I'm showing you only, and you trade those trades up to 100 pips. Now, 100 pips went from the value of $100 to 120. All right. So, well, actually, not 120. Yeah, 120. So, um, so basically, you want to make sure that if you're actually trading, you want to you can create some kind of uh, some type of plan where every so often you can increase your volume. If you're trading too heavy, you won't even get the chance to increase your volume to compound your money. When you go from trading $1 with $1,000 in your account, you get it up to 1,100, and you want to increase that from 11 from $1 to $1.20, and you make 100 pips. You're making $100 plus a little bit more every time. When you get to 100 pips and you increase that to $1.40, you're now compounding your money. You're making the same 100 pips, but you're growing your money faster. The more you make, the more your account grows. Your account, as you increase your volume, it will increase your account exponentially. So you guys want to definitely, if you know how to find great support and resistance stuff, all right. If you know how to find those levels, uh, if you know how to look for price action signals, all right. The next thing is knowing when to increase your volume. You can set your own plan. Okay, after 20 pips, I'm gonna increase my volume, 10 cents. You can set whatever plan you want. Just make sure you keep yourself your marginal percentage or your strength in your account safeguarded. So as long as you're trading at these levels, support support and resistance, and you're getting in on the big moves, even if you don't catch a trade but once a week, you're staying in a trade for a multiple number of days, and you're making over 1,000 pips a lot of times on one run. So it will wash out all the stuff you would have had to endure on the hour chart, all the stuff you would have had to endure on the 15-minute chart. All of it. It doesn't even matter. You are now a profit maker. Not profit, but a profit maker. You can make profit. so um, so that's the power of using the support resistance, right? Very powerful. With knowing how to utilize or with knowing support resistance coupled with price action, game is over. You will not need to know anything else. All you need to know is that the market is going up and down. Where it goes to on the way up becomes resistance. Where it goes to on the way down, wherever it stops is support. And you know that after it stops, chances are it's going to bounce. But don't get in until you have the confirmation, because it can still break through that level. Right? This is not this is no magician move. This is you using logic and common sense. That's what this is. It's let what's common be common. Don't let it become like foreign to you. So well, I'm gonna go through a little spiel now of trading on a smaller time frame for those who might not be able to get away from it, right? And I would only hope that you guys will, because we'll be so far ahead of the game financially. I'm telling you. So, with your lines drawn on from your daily chart, you can always drop down to your hourly, 30 minutes, 15 minutes, 5 minutes, 1 minute. You can always do that. I would say stay with your 1 hour. And when you realize the market goes to your area of resistance, the same rule applies. The same rules apply. The only problem is, I'm going to show you guys, the only problem with this, and doing this, that I don't like, is that although we have, a lot of these levels are sliding scales, you can move it up and down, because they're not exact. Like, that's at the very tip. That's there. That's there. It's beyond. It's above here, which one would think that they would have to put another level here. So you have to be careful with the smaller time frame, because you have to just really look at price action. If I see the market going to this level, I'm just going to wait until I get the confirmation that it's going down and it's below my level to get in. Like this, it went up. It pretty much stopped here, but it went up above it, and then it came back down. When I had the signal that it was going back down, then I get in. Because this is a strong level, because it's plotted on from your daily chart. So we know expect the market move from here. But the only difference is the runs are not as long as it would be from trading this off the daily. So in an hourly, you got to trade all this going up. You can get faked out. So trade that down here. You probably could have put another trade in when it got here and wrote it down and back up on you. So it's like this is what you have to endure. More of these pullbacks, more of the uncertainty. The uncertainty is heightened when you get to the smaller time frames. There's a lot of choppiness. There's a lot more data that you have to read and analyze. I don't need to. If I'm gonna do all this, I might as well stick to building websites, analyze the code. I can do it the simple way. Do this. Less noise. All right. Does that make sense to you guys? Seriously? Okay, great. All right. So now the next part I want to get into is I want to get in. I want to give you guys. No, you know what? Let me ask this. Let me see this. Let me see. One second. Okay, so we have 66 people on right now. All right, so we have 66 people on. Probably had a few thought fellows. All right, so this is what I want to do. I want to ask you guys a question. How many of you have had um, yes, Darius, I am live. On a GBT NZD, I'm live. On a GBT CAD, I'm live. Yes, I am. How many of you had issues with installing your template? Not are you, how many of you have not installed? I'm sorry. How many of you at this point do not have your template installed? The template that I sent you guys when you first joined the movement. Okay. Now I want you guys to know that I've really babied you all coming into this movement. You know, I like to not believe that anyone knows anything. I make it so um, you guys are like on the same level. I know that a lot of you have um, I know that a lot of you have experienced you know, I'm sorry, I sort of got thrown off. All right, so anyway, basically with with the um, with the welcome kit that I sent you guys, uh, I just happen to assume that everyone I don't go in thinking that this person is smarter than this person. I keep everything in layman's terms and I make sure that everyone is getting the same type of instruction. No assumption. Well, I am assuming, but I don't assume that you know something, but then I shorthand you, I undercut you. So I just assume that everyone's in my mind, everyone's on the same level. You start off on the same foundation, build progressively. So that being said, I want you guys to know that I created a video for you guys to install your template. And that video will show you how to install it without a problem. Um, and I know for some, you guys had no issues. Some of you, MT4 might be foreign altogether because you're new. So you might not know. I know I've assisted a few of you with installing it personally using TeamViewer. Uh, you know, but my question is, how many of you had issues even after using the instructions? And I have some that say, even here on the replies, that the instructions were very easy. And it's okay if you have problems. It's really okay. I'm not trying to put no one on the spot. I can only see your responses, not like your peers can see your responses. It's only me. So I just want to get a sense of what's what. Okay, okay. All right. So um, question there you go. It was so darn easy. That's right. That's right. Very, very easy. I want you guys to know that if you guys have not if you guys have not watched the video, I do not want to get into a hand holding thing where I'm holding everybody's hand to do something that's already provided for you. You guys must watch the video and try it for yourself because when you're trading on your own, I'm not trading your account. So you have to, like, this is stuff that I've taken my time to create for you guys so that everybody can just fall right into it. Bam, get right in, no questions. So I want you I want you guys to try that out first. How many of you tried it on a Mac without a problem? A number of people tried it on a Mac, no problem. I actually have a Mac, no problem. Um, so if you're having a problem with installing it on a Mac, you definitely want to go through the instructions again. Um, either that or I'll install it for you. I'm gonna charge you $500. No, I'm just kidding. I'm just kidding. Yeah, if you're hold on one second. If you're having problems with installing it on a Mac, I got you. Um, I installed mine on my Mac and I have no problem with it. I installed it on my PCs, no problem with it. But I want you guys to know that everything that I do, I make sure that it's done right. I'm not gonna half step anything because I'm gonna treat you guys the same way that I want to be treated if I were in your shoes. So I'm gonna take care of you guys. I'm telling you, just trust me and believe it. I will take care of you guys. So so with that, let me just I'm gonna run through this really quick. Just gonna run through this really quick. And this is for you guys that do not know how to do it. This is all that you do. Let's just say, for instance, uh, let's see. Let's say, for instance, you have your. I'm just gonna put something here. Let's say key text. Let's say this is your file, all right? So that's your file. This is all you do. Go here, go template. You look for that file. Go back here. This file is in your desktop. This is in my desktop. So all I do, click on desktop, and it will be there. It's not there, of course. That text file is there because it's not a template file. This means template PDF. It will be there. When you click on it, double click on it, the entire name of the file will be here. Click over. Boom. That's it. Another way you can do it, you can go to File, Open Data Folder, Templates, and all you got to do is you can drag your file inside that folder. Done. That's it. Easy peasy. Not a whole lot to it. Not a whole lot to it. I'm trying to say. So, and that video too is in the back office. So, I want to make sure that I'm not. I know that I put my hand in my work. Everything that I do, I put my hand in it. I want to make sure everyone is under the same. So you had a text extension. Not really sure why. It should have came in a TTL, not a text. Everything that I sent, the 4 files or 5 files that I sent, it's all the same. I never have to change the file. They're all the same. It's really a template. when I send you all, when you all join, it's just a template. I send that to everybody. So I don't go in and manually add the files to any email. So it should all be the same. The way you do a blank template, for those of you that want to know, all that I do is, let's go to something that, of course, I would remove these. And then, so this is a blank template. Then I would just go here, go save template, and I can end it. Blank 1, now 10, blank 1. But it's the same, it's the same thing. I want to remove the template, I want to remove blank 1. Yes, I want to remove it, blank 1. So all you do, you know, if you are one who likes to put all types of stuff in your chart, you can do this, save template. Dummy template. I would be a fool to use this. Blank, dummy template. Very simple. Remove it, remove, dummy template. Yes. No longer there. Alright, very simple. So now let's get into, I want to get into my last, I'm not sure how that happened, but you can always, just put TPL in there, change the extension yourself, but I'm not sure how that happened. You know what? I think I know what happened. You probably opened it up and you probably accidentally saved it as a text file, because it's not coming to me as a text file. You probably accidentally, inadvertently saved it as a text file on accident. Alright? So let's get back into the actual lesson. We're nearing completion. Now, so we've already covered the first two portions of trading, how to trade. The first one is, as you guys already know, the first one is, let me see if I can find something that's pretty groovy. I have all of these on it because I'm a designer, so I have a lot of different fonts. I should use this. So basically, the first rule is always support and resistance. All right, support and resistance. All right, one too many keys. And we also know that the next one is looking for what? After you have support and resistance, what do you look for? Right. Price action. That's what I'm looking for. Price action. That's great. So we look for price action. All right. So we have price action now. Now the third thing would be, now keep this in mind, you can literally trade off just these two. And you know what? I'm going to say this. I want you guys to challenge yourself. I want you guys to challenge yourself only trading. If you're trading demo, or at least you guys open up a demo account and try trading as your support and resistance line using my instructions only. Do that. I'm not gonna tell you what to do with your live money. You do what you want to do with that. I'm not gonna tell you. But at least on demo, prove me wrong that what I'm telling you doesn't work. Prove me wrong. So on your demo account, trade this. Support and resistance only. Only get in at support and resistance and then follow price action. All right. The next thing you want to do is I'm going to throw in moving average. Throw in my 7. I'm going to throw in my 14. All right. And don't be distracted by the support and resistance lines in your moving averages. Don't worry about that. They're all going to tie in. So what I want to help you guys with is that. Well, my question is this. Let me ask you guys a question. Do you know why you moving averages? Thanks a lot, Boris. I appreciate that, brother. Same to you. Right, because they're moving averages. Real funny. All right, so uh, uh, so let me just explain why you're moving averages. Moving averages for one are very powerful. Very powerful. There's one flaw to moving averages, and that's the fact that they lag. Supposedly, when you have the cross of the moving average, supposedly that's when the momentum has shifted. But if you notice, the cross happened here. The signal came up here. So we know that they lag. That's not entirely true, right? So knowing that, when you only use the yellow and the red as a confirmation, like a triple confirmation of this, you have gotten in the market at resistance, and you have price action involved in candle, you're in a trade on here. By the time the cross happens, you're already in the market. You're already making money. So your cross is nothing more than just another layer of consolidation. I'm sorry, another consolidation is definitely not the word that I would intend on using, but it's another layer of confirmation. All right. So with that, you know that you get the cross here, the market goes down. Right? It's going down. So you're like, man, I'm in the money. I'm in the money. How can I lose? Well, you can lose if you don't pay attention to the market. So don't get too happy just yet. I'll show you how to always win. So what happens is this. The cross is the confirmation. And let me say this first. For those of you who are new to this, that this might help you realize the clarity of power for moving averages. The yellow and the red, whenever they cross, let me do this. Let me take this. We already know that the yellow. Let me just throw it down real quick. First one is support and resistance. Next one is price action. All right, and then so now we move forward. Okay, now look, check this out. Wherever you see the yellow cross below the red, the market will go down. Wherever you see it cross below, it will always go down. Quite frankly, the yellow hasn't been above the red and all the way since up here. Since here. end of May. So for the entire month of June, the market was actually below, or I'm sorry, the yellow was actually below the red. So if you were in on a downtrend, you could have just been in the money. Forget about this crap, you were up here. That little subtle retrace ain't nothing. You're up here. You've been in the money. I hope that that's opened your eyes. Because you could trade just off this alone and kill the market wide open. I'm making winners out of you guys, not losers. I don't want you guys to lose. I want you guys to win. So I'm going to show you how to get the money. I'm going to show you. So pay attention, please. The yellow and the red, the market goes down. The yellow above the red, the market goes up. This is back in April 2015. This is back in September 2015, when the market stalled, as we went over this earlier, before declining. So the market went from here all the way to 245, 246, with the highest of 253, but the market stayed above the yellow for the most part. I can still hear a snake below. That's all because of this dip. So one could have stayed in the market and killed the market. That's why I said I traded this, like 60, 70% of this was traded by me. How many signals do you need? Very easy. It's so darn easy. It really is. I'm going to make successful traders. That's my plot. That's my aim. That's my goal. If I don't do it, who will? Stick with me. Follow me. Anywhere the yellow goes above the red, the market goes up. All right. Anywhere the market goes yellow underneath the red, the market goes down. Anytime the yellow goes underneath the red, the market is in a downtrend for that moment. And whenever it goes back above the red, it's an uptrend. All right? Very simple. Now, it gets deeper. If you only wanted to trade at support and resistance, like this in resistance, this in support, you could trade only when the price action, meaning the candles, are above or closes above or below the yellow and the red. Meaning this candle here, if I not zoom in, this candle here closed below, not the wick. It closed below. The market can go all the way down here and pull back above it where it closes. So the market closed below the yellow and the red. That could have been your signal, okay? One, the first signal was that we're at resistance. Now you just wait for it. If you do not want to wait on price action to show you, like price action meaning like the candle setup, you could just trade off of price action, but when the market goes below the yellow and the red, or when it goes above the yellow and the red. Meaning when you saw that price is at this resistance and price closed below the yellow and the red here, you could have waited until to see what this candle did before you got in. And look what the market did. It stayed below yellow and the red. It didn't close back above the yellow and the red.
Hey man, it's Jeff. Hey, you guy. Hey, I can't play a bit, man. How you doing?
So that's how you can do it. There's a couple ways you can do this. You can get in on the market just below the yellow and the red.
I'm doing right now, and I'm download speed at 14.3.
Wait for it to cross back down. So I would get out. Same thing. You get in when the market closes above both the yellow and the red, you get in, you ride it up, and still.
So you guess the difference over, you mean?
You still gotta look for the resistance level. Around where your support level.
Gotcha.
Around
Gotcha.
because
Alright, hang on one
after
second,
this one up to here,
You got a minute,
it
or?
goes back down below the other. Yeah.
Okay, I got a training going so you can hear a voice in the background. Hang on.
Goes below it, below the market down. Now, I'm not saying closing above just one, closing above both of them. Once it closes above both of them, that's when you know you got the market. Alright? So, close below both of them, the market goes down to a level of.
Yeah, well, the only ones that's showing me are Tucson, and then like Wilcox.
Above it, it's not the profit. Always take it, regardless of what method you use, always take it as your support.
Oh, I see.
And it's just always. That will be your way of getting the most out of your trade.
I got you, man. Okay, I actually went down to Mexico.
Always be your way of winning. Always.
Yeah, I got Phoenix. So I got a Tempe. All right, let me try Tempe. Here we go. We'll see what it says. Yeah, so yeah, that's 10 times better.
Let's see.
Yeah, so we're in the 40 range.
So
Well, let's let it finish.
Explain to you how these work. The yellow and red line, they're like strings, right? And so let me go back to why you.
All right, so it's at 42.
Moving averages are very powerful. While they might lag, the moving averages, there are some price movement averaged out to one number. Back in grade school, our teacher had us add up 5 numbers and provide him or her with the average. Doing so, you add all the 5 numbers up and you divide it by how many numbers you had. How many numbers do you have? How many numbers did you add up? 5. Once you divide it, that gives you your average. Averages will never lie. You go to school, you're A student in this class, a C student in that class. The average student you are will be a B student. It's just an average. But it's that simple and it's that easy. The averages won't lie. You know why? Because this is the day chart and this is a 14 period, meaning the 14 day. The period is meaning the time frame. So 14 period, 14 day moving average. What that means is 14 days back, this is the average price. Right here. Not up here, not down here, right here. 7 days, 7 period moving average. 7 periods of 7 days. This is the average. Right here. The moving averages will not lie. They might lag in terms of the cross if you're using it for entry. But in terms of the location, X and Y axis, whatever you want to call it, whatever you consider it to be, it's realized and it's averaged out automatically for you. So that's why you move an average, because that number, that average, is the sum divided and it's equals to what it is. This entire world is based off of numbers. So when you look at, which is why they always say that the market will move to these certain levels and always bounce. Even levels, 2.0, the 1.0, whatever, the 1.5, as they call them, psychological levels. But nonetheless, if it's a number, it's the reason why we have about what we have in front of us. We are definitely you guys are look. I don't think you guys know how powerful this knowledge or this intel is that I'm providing you guys. Very powerful. You know, when you guys were in grade school, there were 4 parts of math that was taught. You learned that in grade school. All you needed to know was the basics for you to mature and learn pre-calculus, algebra 2, trigonometry. All you needed to learn was those 4, and everything else was just a process. Which one to do first? That's all it is. When you learn the process, and when you learn about how this stuff really works, you start looking at trading forex. You're calm when you're trading because you know that, hey, there's nowhere the market can go. The market is only, if the market, somebody told me the market will only range from here to here, and if I had $10,000 in my account, and I was trading at $1 a pip. This from here to here is 10,000 pips, so I know I can't get knocked out the market. It's not even happening. So you know what? I said, okay, I don't care. I know I can't get blown out the market unless I trade too heavy. If I trade it at $5 a pip, and the market goes from here to here with $10,000 in my account, yes, there's a chance that I can get thrown out of the market. So it's very important that you realize 2 points here. The moving averages, how powerful they are. That is the 3rd step here, just the cross, but the cross is nothing more than confirmation. All right? But also, moving averages will help you see when you can get in and the market is underneath the yellow and the red. Or let you see when you can get in when the market is above the yellow and the red. So now you can ride it up. It'll help you like this. The market is at support, the market broke above, and you could have rolled it up. This happens all the time. So if you're trading off of these major levels of support and resistance, and you catch one of these, you know you're at the forefront of a big move. You already know it. It's going to work out. Follow the rules. Very simple. Now, that's the yellow and the red. The yellow and the red are your directional moving averages. They are very sensitive to price action in the current price. I drop down to the minute chart. You'll notice that as this thing pulls down, you will see the yellow flicker. Or if it goes up, you will see it flicker. The yellow is very sensitive to price action. See it move as it went up. So as you see that, just pull right down. It's just like strings. Just like strings. Imagine if you got in here, the market closed below that. So right now you could literally be in the money almost 8, 9 pips. Literally. Just off of that. Just off of that alone. You can trade these strategies on any time frame, but this is a good example of why I wouldn't trade it off the minute. Because you would have got in after this, but look, where did it go? It went up. You know, this was a good move. This was a good move. This right here told me it was definitely going up. Consolidated, broke above it. You could have got in here and rolled it all the way up. 20 some pips. more than that. All the way to there. $42. This is the minute chart. Here's resistance. Now I'm going back down. You could have got in, mark close below the yellow and the red. It never closed above the yellow and the red here. Still below it. But it got in. You would be, well, right here, I would say here. You made 50 pips. Above the red, you wouldn't have made much money. You would have faked out. I would take this going down. I'll be afraid to take it going up because if it's coming down from a major, if this is a major resistance level, it's coming down, momentum is going down. So know that gravity. If you understand gravity, what's going to happen? I wouldn't care about this. Not that it can't go up because it was almost at that same level as the market was at. So it's not that it can't go up. It's just I would be a little cautious. That's all. So, and that's where putting in your major levels in lets you see where it's likely to really bounce off of. Like this would have told you, okay, it's not bouncing on, it's not a major level. So that's another way you can do it. Now, so with the yellow and red, you can get in at resistance just like anything else. Get in at resistance, price action. This way it was clear. 1 minute chart. Engulfing candle, market close below. The next minute, next thing you know, it's going down. This is where it opened. It opened with its edge up there, but it wasn't closed outside. It closed here. This is the close. Those of you that was like, oh, okay. But that's the close. So you would have rolled it all the way down. You may have even gotten out here, but I probably would stay in because it was still wrapped around this. And kind of taking the market to here. So this is that. Let me go into the purple and the red. Because remember, when you the yellow and the red are your directional movement averages, okay? The purple and the green will be your movement averages that are more like support resistance. All right. Now, with these moving averages here, I'm going to go through the chart on the daily, and I'm going to show you guys instances of the market balancing off of these levels. Right? Just here alone, the market came down, hit off your resistance, came down, hit support, bounced off the green, came down, hugged the purple there a little. Okay, went up to the purple in this wick, then hugged the purple here, hugged it here, came down, hugged it again, came down, went to the green, came back down to the purple, to the green. So it's no surprise that these moving averages are being hugged. Sorry, there's no surprise that the price is being hugged by moving averages, or they're clinging to it, or they act as support and resistance. Sit right on the green. And right down to the green. Right on the purple. Right on the purple. Purple. Came down to the purple and the green. Up to the purple and the green. So this is what I tell you guys. You can use these moving averages support and resistance. Alright? So example, let's go with a real example. You have the market here. Okay? Resistance. Let's draw on, put out 7 and out 14. So let's look into this. So we already know that we have resistance here. Oh, sorry. So we already know that we have resistance here. We know that. So we were expecting for the market to drop, which it did. So if you decide to wait to get into the market after it crossed below the yellow and the red, you would have been in the market on this candle right here. Right there. Same thing applies. With your support, of course, remember, you always look left and show that the level is good. But because we did this already, we know that this is a good level. We know that this is a good level. Something interesting about this level is that this level here is where your resistance is as well as your green. So there's like a double layer here. So if you put a double layer of sheetrock on the wall, you make them a little bit more stronger, right? Exactly. It's logic. So that gives you a little bit more emphasis on the move down. That's what happens. Right? So basically what you could do, if you don't feel comfortable with taking profit all the way down to your support, what you did. What you could do, so you get into the market here, and ride it down to each moving average. And re-enter after you get the confirmation that after if you feel like it's going to keep going down, you re-enter and go and keep riding it down. And take it to the moving average because they will stop at the moving average lots of times. And just ride it down. And whatever price action meets first on the way up or down, whether it's support, resistance, or the yellow, or the purple and the green, you can take profit at the levels. You know? Case in point, it's right here. Market is at resistance and go off the candle. You got in here, you took your profit at the purple, maybe in the green. I actually traded this. I got here, here. Took profit here. Here, yeah, I took profit here. I didn't get back in until I broke through the green. Took it all the way down, and I traded it back down. So you could easily just take profit at the moving averages, and then take profit at your support and resistance levels, and then go from there. Very simple, very effective. Very. One thing that let me say see if there's anything else that I want to share with you guys. Let's look at some questions. So let's go through. Let's see. I'm just going to read through some of these, answer some of these questions. Alright, I got a question about why do I only have 3 trades. Basically, I trade my account based on the size of the account that I have, and I keep a certain amount aside on my trading accounts. And instead of putting in one trade, I would rather see a smaller portion. If something was to happen, I would rather see, a smaller portion out of the money than big lump sum. So I trade, I trade 3 trades at a time. That way, if for some reason if it went against me, I could lessen the blow by closing out 1 trade, and I could just leave the 2 running, just in case it, if it turns around and I can pop it up again, instead of having to close out the whole thing. Right? So, to be, someone asked about different moving averages, different types of moving averages. You might want to try that out yourself and see. To be quite honest with you, I only use simple moving averages. Whatever it does to your moving averages, when you put them on linear, exponential, smooth, that's what it is. But I only use simple, and I will only train you guys on simple. Simple works for me, so why even, I don't even cloud my mind and know anything other than that, because it works so well. It's like a standard. So, trying to see if there's any other, hold on, 1 second. Okay, yeah, I don't see any other questions there. Anybody have any other questions? First of all, let me answer this one first. It's the 7, 14, 33, and 60 moving average. I have to do this. All right, so let me ask you. Okay, the question was, last week I mentioned that you guys, for those who were here, I had pointed out that the AUD NZD was in a consolidation. And it broke out of that yesterday, 2 days ago, technically going up in the trading world. But today, technically, or yesterday, technically, on the trading world, question was, do you get in? I don't necessarily get in just because it turn around. I would wait. That's just me. I want a clear move. See, for it to break out of it and go back down to it, that's not clear enough for me. Like if I didn't make it on the way up and it turn right back around, then I'm gonna fall back until it's clear what it's gonna do. So that's just me. I don't want to gamble with it like that. Sometimes when price consolidates at support or resistance instead of bouncing off it, punches through, how do you trade that? All right, real easy. And this happens very often. If you had your resistance here, and you got a wick that push through there, you always want to, if this is your resistance and it's very strong, which we see it is a good level of resistance, to punch through. I'm not going to trade this going up until I get the confirmation that it's going to go up. Punching through is not, having it pierce through is not enough for me. I want it to close on the other side. And then, because it's a level of resistance, if it closes on the other side, even if I waited a day, because that's the day chart, if I waited a day for it to go up so I'll have like a thorough confirmation, I would do so. Because I already know I'm at the forefront of a move going up. Just like this move going down was big like this, went all the way down, this move could pierce the ring, go all the way up. So waiting a day is nothing more than me getting in here. Just flip this. This will go up, and you get in on the next day, which will be this. So wait for it to close, all right? Or just wait for, a signal at that level. So that's what that is. No problem. That's great, Sam. 160 tips. Fantastic. Let's see. Yes, I do send signals on occasion, but it's not to be expected. It's not to be requested. It's just when I'm gonna send, if I send a signal, I'm gonna send a signal that's clear. I'm not gonna put you guys in any harm. But that doesn't mean that I'm gonna tell you to go long or go short either. Really, when I send a signal, I'm letting you guys know that they watch this area and just watch it. I'm not gonna give you any clues. Like the AUD and the D. I just told you to watch this area was consolidated. You guys had to trade it based on how you want to trade it. So I didn't tell you to get in long or short. So let's see. What if there's a big bounce where we never touched the pad, you still use it? Big bounce meaning a wick. You're not able to, you guys are not able to see anything, any questions that are going on. So anytime there's a question, I just have to, repeat it because that's just the way the system is designed. Big bounce that support and resistance. Okay. So basically, you're talking about if, like for instance here, the market hit off of this and bounced all the way up. Is that what you're referring to?
Yeah, first time works fine.
Well, that's just the reverse. Whether it's at the top or bottom, that's the same thing. Whether it's at the top or bottom, it's still a bounce. But if the market, if you had a wick at the top, then that will be. It depends on your signal. Like the way I read a wick like this, it really depends on the situation. If you're at a major level of resistance or something, not this. This is news. This is news too. So I don't consider the news to be a factor. Like if the regular ebb and flow of the market, if I get a pullback, nice, clean, and clear pullback, my first thing is pulling back because it's resisting. The pullback at the top is resisting it. It's going down. So I put more emphasis on the move going down. Just like conversely, if there's a pullback at the bottom, it goes back up. Then I'm going to expect it to go north because it's resisting the support level. All right, it's the well supported level. It's not allowing you to get down there. The bears are saying, the bulls are saying, oh no, we're going down. So that's how I would do that. That would be a signal to go in the opposite direction for me. Will I ever offer a copy trader service? No, I would never do that. Quite frankly, I have a reputation, and I don't. I don't. I care about my reputation too much. The market is. One thing that I always say, and this to everybody, because I get that quite often. When it's nice to be a trader and know what you're doing, but the market isn't for it isn't forgiving. The market can turn around on you at moment's notice. I go upstairs and talk to my wife real quick, give my wife a kiss and give my daughter a kiss. Hey, how you doing? Yada yada. And then I come back and something done happened. And if I'm trading the group's money, or if I'm trading and you guys are following my trade, that could be detrimental to our success. Our relationship is compromised then. So I would never do that. I wouldn't do that at all. I enjoy teaching so much because it allows you guys to learn so much more. Uh, let's see. Okay, if all three signals together work on all pairs and commodities, why do we have to study a pair? Really, because you should. That's just you should want to, because the market is never going to be in the same position it's in right now with everything in the same position. So you have to study the pair, because the market goes from a ranging market to a trimming market, and just because you might be familiar with all three things, all three signals, you still want to apply certain things and consider certain things in certain ways. It's just something about knowing your pair. You have to know your pair to know how to respond to it. I wouldn't tell you nothing that's going to hurt you in your learning. You can either make. I look at it like this: you can either make consistent money on one pair, or make a little bit of money across a lot of pairs. That's as plain as I'm gonna put it. I would rather make consistent money, because we're all in to make. I want to make $1,000 a week. That's a multiple. I want to make this a week. That's consistent. When I make $1,000 a week, then $75, next week. That isn't consistency. So, yeah, trading those would be definitely great. I'm telling you, just focusing on a couple pairs and mastering them. Put it like this: if you can master the 3 steps, then you can master. If you master any pair, then game over. Yes, all pairs have their own personality. Yes, yes. How do you study the pair? You study the pair by backtesting. You study the pair by looking at the price moves. All of this is studying the pair. Just If you're new to trading forex, do not be overwhelmed. You'll get it. The more you look at anything, the more you become familiar with it. So if you're not familiar with the pairs because you need to study, you basically if you are not familiar with the pairs because you need to look at it. Because the more I look at something, the more I'm going to know his personality. The more I'm around you guys and I know, okay, this person is a little edgy. I want to know, okay, well, you know, I know what to expect because this person is edgy. Oh, this person is calm and cool. I know that they won't be, real on edge about certain things. So same thing. It's real life. Same stuff. Same stuff applies. That's great. That's great. I one of the students has been with us. She's saying that she's been using my strategy, and even on demo at this 10 cents, she's making good profits. So she's loving it. How do you see candles kind of from above or below? Easy. Okay, so the question was, how would you see a candle close above or below if averages are behind? Well, averages are not. Yes, sometimes you might see the averages like this, but that's not everywhere. That's not everywhere. That's just right there. So that's when you gotta have patience because if you want to get a microscope and zoom all the way in, you can do that technically, but you don't have to play that role and being real technical. You can just wait for it to be clear. Like this is like on the line. Technically speaking, it closed below it. Well, I mean, well, the purple, the yellow, and the red is above it clearly, but if I had to say the purple, it closed below it because it's a sell candle, but you can you can situate you can wait until you get into the market when it's clearly below it or above it. You guys, please keep in mind, do not be so quick to jump into the market. The market, you guys gotta understand that you gotta have patience. This is to everybody. This is not based on that question, but it just made me think about this. Like you guys gotta know that one day in the past, on May 31st, this was the market. Just like today, the candles here, this was where the market was in its presence. This is where it was at. It was at this level of resistance. And then it couldn't break through and it had to go down. So if you learn to I'm telling you, do yourself a favor and practice daily on a demo account. Once you start doing this on a daily account on demo, everything else becomes I don't care what a buddy is talking about on the hourly. Oh man, you see what happened on the daily on the hourly? It went down 4 or 5 hours. I don't care about that because guess what? Those same 4 or 5 hours that it went down, I caught it on the daily chart and more. While you only got 4 or 5 hours, while it retraced for an hour to went sideways for 2 hours, it then went back down for after those 2 hours, 3, 4 more hours, and I put all of it. So you want to get the entire move, and you gotta be patient. So if the market is sitting at the moving average, don't worry about it. Wait till it move off of it, because it's gonna move off of it. It's not gonna stay here forever. It's gonna go up and down, and up again, and back down. It's gonna do it. So just because right then and there you're looking at the chart in its position right there, it's gonna move. Don't worry about it. Be patient. Trust me. You know what I'm talking about. So let's see how we I can use the trades. These are standard candles. I don't use the Hikanashi. I don't use none of that stuff. I don't. That's uh, yeah. I don't use that stuff. So these are standard candles. I'm telling you guys. You guys gotta like. You guys really gotta believe in what you're looking at. Like I know that some things are too good to be true, but the reason why this is too good to be true is that you were learned. You were taught a different way if you've been doing this for a while. So once you start to believe in what you're seeing, everything else will not even matter. All right, everything else will not even matter. So I want you guys to I want you guys to definitely keep that in mind. We got a few more questions that came in. Let's see. Do I only look at the daily chart? Well, not always, but I always trade off of the daily. The only time I might go down to the 4 hour, in fact, I never trade off the 4 hour. I always trade off the daily. If I go to the 4 hour, it might be drawing lines, support resistance. The daily is I'm telling you, the daily is my play to it. I tell you. And then if I look at the hourly, because I never go lower than the hourly, but if I look at the hourly, it's just because the market is consolidated, and I need to find an entry because like this, I'll show you guys. This right here, there was no clear signal that the market was going to go down. It just went down. But if I contain this area, like so, and I'll probably make it bigger, and then I drop down to the hourly, I just wait for a signal outside of this zone. And once I get a signal outside of this zone, because on a daily, it didn't provide that. It didn't do that. I would have had to literally wait until the market gapped down and then, that could have been a signal. But a gap down, that gap is what you're losing. So to get that because you see that it's actually gapped down, I want that money. I don't want to give that money away. So I'm never go down to the hourly and I'm gonna wait until I see the market cross outside, close outside of it. Then I'm gonna get in and ride it down. And it's like a double whammy. It was at the purple, didn't break the purple. The golfing candle down, the golfing candle is also below the yellow and red. I'm dipping at the next hour. The momentum is down, and it's outside of my container. Like 4 different indicators telling you it's going down. Logic will tell you, follow your logic, follow your gut. I'm telling you, you gotta second guess yourself. Let's see. All right. Let's see. The best platform to use is really whatever whatever you like. Industry standard, I would probably say is MT4, but there are other platforms out there that you can use for charting. Um, what time of day should we enter off of the daily? This is how I trade. If I don't have no trades open right now, I don't get in based off of the current session. Very low volatility, low volume. I would get in because it's a new candle anyway. I would wait till the London session or New York. And if it doesn't show me something, if it shows me something, I'll get enough of that. there's a range on the daily, and you go to the hourly to trade. You draw extra support and resistance levels on the hourly too. All right, just like I just showed you, but in a different way. So this was the range. This was the range here. And if I had drew this on and went down to the hourly, basically the question is, if I found a range on a daily and I went to the hourly, do I need to draw on more support and resistance? So I'm going to answer that question. And this is what I would do. I gotta go all the way back. Man, I do not want to do that, but it's okay. It's like the best area for the example. And that containment was not clear. All right, so gotta move this up some. So basically, the containment is with this. It is the support. You know, that's why I drew it here. That's why I moved it up. It kind of is support. But as you get out of here, as the market, and this is something I want you guys to know too. Follow along with this. As the market, if you act like none of this is here, none of this is here, the market is here. As the market drops down, well, this might be a new level that's not over here, that hasn't been realized before. So as the market is dropping down and going back up, it creates a level you can draw your line. I would say on your hourly chart, you can do that. You can do it on any chart, but on an hourly chart, definitely, because on an hourly chart, you have to only draw your lines on everywhere it goes, because the levels on the lower time frames are very they're not very they're very weak levels. They're not strong levels. Some of them the levels off your daily might carry over and be a strong level on your hour for sure. But the levels that you have to draw in, some of them are stronger than the others. But it's just that you want to definitely draw on your support as you're going along. Once you're out of the containment, you're going to want to do that anyway, because now you're like in a wide open space, and none of this is realized yet. So you want to, as the market goes down and it plants its foot, you draw a line. Then it goes up, go high, then you draw a line. It bounce off that, go down, plants its foot, draw a line. That way, as you're going forward and the market goes up and reach them lines, the market can reach the same lines. Like for instance, I drew a line there for this, and drew a line here for this. You see the market came here, then it dropped right down here. I'd have been taking profit here. And look how it went sideways before it broke below. And when it broke below there, I would have put a line there. And look how it came down, bounced up, hit off the red, came back down again. Then it went up. Now I'd have been taking profit at the purple. And then here again, then the green, look how it hit the green. Then it went up to the same level over here. So as you're going back and forth, as the market is going about, it's hitting the same levels again. Came back down to this level again. Came back down to this level again. So you've been making the same money off the same levels time and time again. So yeah, that's a fantastic question. Fantastic question. I really appreciate that. Thank you so much. So let's see. All right, now, Forex Factory. I know that's been asked a number of times. All right, so with the Forex Factory, for those of you who want to know about looking at fundamental trades and stuff, this is what I would tell you. Well, first off, I made a video, and it's inside of the back office for Forex Factory. Show you how to actually do the Forex Factory. You know how to look at it. So that's there. All right. So I want you guys to make sure that you take a look at that, and you know, so that's what I would have to have you guys do. It's very simple. It's nothing hard about it. All you're looking at is the dates. If you see the actual currency pairs that are going to be not influenced but affected by it. You have like a description of the type of fundamental news event itself, and you look at the history and see how this news event panned out in the past. And so it's very simple. It's nothing hard about it. I don't follow the news events. But there are two that I would actually look at, and that's the FOMC and the non-farm payroll, which in fact that's tomorrow, non-farm payroll. So I can show you guys how to trade that. I can show you guys how to trade the news. But I need you guys to really follow me on this. This is very important. This will pretty much wrap up our training. If there is one other question that I want to answer that I just saw. So usually what happens when the news come out, when a lot of pairs or at random, you'll notice that the market has been going sideways. And whether it's going up and the news come out and go down, or if it was going up and it keeps going up, or if it was consolidating and then it broke down, or if it was consolidating and going up. It can only do a few things before the news break out. Either consolidation and go up or go down, going up and keeps going up, or going up and go down, or it was previously going down and keeps going down, or it was previously going down and then go up. The only thing that it can do. Now, this is what normally happens. And this is probably why I don't trade the news. But this is what normally happens. And I can show you on here. When go back to the hourly. Oh, I'm going the wrong way. Sorry that you guys. Bear with me. Bear with me, please. So, when the news comes out, this is what happens. This was in 1 hour. This happened. This is what generally happens. The market was already in a noticeable uptrend. And just to let you guys know, I was in on this trade. The market held support, it was going up. I was trading for the daily, but it was of course this day was a daily, it was a bullish candle. Because I was already long, it made it a great day. I'm trying to tell you, I didn't ride it all the way up. I caught it about day high. It was a great day. But this trade here, it goes off the side. 1,240 pips. And what did it do after the news was done? It backed all the way back down to the normal price action levels. And then it acted like it never happened. And this put a lot of people out of commission. A lot of people. right? So I'm showing you this because usually what happens when the news come out, non-farm payroll being tomorrow, usually what happens is the market will go up, and then eventually it'll reach its peak, and it'll start backing off. Or it'll go down, and it'll reach its level, its low, and it'll back up. That looks like a small wick, but that's a hefty wick right there. I'm trying to tell you. 270 pips. It's not a small wick, not at all. So when you see the news release break out, if you don't catch the initial move, don't worry about it. Because you know it's going to retrace and go back down. Or it's going to retrace and go back up to normal price action, and it's going to ever go like it never happened. It's going to cool off. It's the cooling period. So don't worry about it. If you don't catch, I personally don't like catching the initial move. That's too stressful. I don't like stress. I like to keep things simple. You guys have notes. I like to keep things simple. So if it's stressful, I don't need to deal with it. That's why I don't trade the news no more. But sometimes I might tell you, no, I'm not doing it. Let me go ahead and trade the news. Just to play around, make a few dollars, you know. And you guys can do it, but only trade the news. You don't have to trade the news. You can stay out of the market when the news is going on. Sometimes the non-farm payroll will have the market jumping for 3-4 hours. So sometimes it might only jump for an hour, sometimes 30 minutes, but you really don't know until you're in the thick of it, and then it's too late if you're in a wrong trade. So I just want you guys to know that, you know, you can trade the news, but I would trade the retrace. As soon as the market up, and you realize that the market, because this is what happens. And I want you guys to follow. This is what happens. Sometimes the market, the news will come out, and it'll be going sideways, and it'll go up, just like the London breakout. It'll be consolidated, it'll go up, and then it'll shoot down, fake you out, you know. Or sometimes it'll go sideways, go down, then it'll hammer its way up. Or sometimes it'll be going up like this, and it'll just go up. But then think about it. It took the market out of its range. What this did. This was an extraordinary news event, not some non-farm payroll. This was extraordinary. So it took the market up, and so because it was extraordinary, that's why it backed back down. It was not the normal temperament of this pair. This pair moves, but this is by far like out of its range. In 1 hour anyway. Maybe in a day it can move 700-800 pips to max in 1 hour. But nonetheless, if you don't catch the initial move, just watch it. That's the best thing you can do. Analyze what's going on. Analyze what the market is doing when the news come out. You see the market, it'll do this. It'll open up and it'll start pushing. And you'll notice it'll come up to a certain level and it'll back off. Come back up to the same level, then it'll back off. And it'll do that a number of times. Then it'll pinch up a little further and back off. And it'll start going higher. Keep backing off. Then sometimes you might get a burst and it'll burst up some more. Then it'll back off. And then it'll do that. You know? So what you want to do is time it. Because if you see that it's going up to this point, about where my support line is, and then it's backing down to about my price action, it's constantly doing this. You see it do it for a number of times, you just time it. Put your buy in, ride it up, close out. Put your sell in, ride it down, close out. Put your buy in, ride it up, close out. Put your sell in, ride it down, close out. You can do that. But just make sure you're watching it carefully, because sometimes you don't know when it's going to not go back down and keep going up. put that buy in or put that sell in, and it's pushing in the opposite direction. So just be careful. Sometimes if the market's going up, I would just let it go up and just let it realize or create its own resistance and then ride it as it's going down, pushing its way down like this, going down, going up, going down, going down a little further, then going up, going down a little further, then going up. I'll just ride it down back to the normal area. That's all you do. Now, it doesn't always happen that way, so I caution you. If you're going to do this, sometimes the market will just go up and keep going up and just keep going up. Sometimes it won't go up and come back down. Or sometimes it won't go down and come back up. It'll just keep going down because the move of the news is actually in tune with the actual flow of where it's already headed. So you just got to be careful. And every month is different. Every news release is different. You can't say though because the last month it was this way, the news release was this, that it's gonna because it was positive and it went down, and it was positive news this time and it went down because last month it shot down and came back up, and this month it got a shot down and go back up. No, you just gotta it's your timing, and that's why a lot of people they stay away from. I know how to trade, but I don't trade it all the time. That's just adding a risk to I don't like risk. So, you see, that was a question. Do I just open up a trade and let it ride all day, provided my first two areas have been, um, my first two requirements have been filled? If I have support and resistance, realize support and resistance and price action, then I can let it ride all day, provided it's going in that direction all day. Well, if you're in a market and the news goes against you, you better hope you can close out. That's what I would say, without losing all your money. I mean, that. It don't matter if it's news or whatever. If the market goes against you, you want to close out or do some kind of hedging technique, and that's something that'll be added to the back office too. Uh, oh yeah, of course. If the market goes against you, you can definitely get margin call. Let's see. So you always close everything for releases. No. If I have news, if I know the news, the thing is, I know the dates of when the news is coming out. I know that the FOMC and the non-farm are around the same time, and I know that just by trading. If I have trades that are open, I might just be careful with trading those that are affected by that type of news. But generally, I don't care about the news being out because if it takes the market against me, then I just find a way to get out of it. Let's see the London News session. Yes, if you're not awake during the London and New York, I would not leave any trades running. I mean, if you have a stop loss, that's one thing. If you use stop loss, that's one thing, but if you don't, I would not leave a trade running. In order to capitalize on the London and the New York session is to trade it. I mean, uh, like I said, the London and New York is you can get in 2 or 3 o'clock in the morning and ride them all the way up to go ride. And, of course, those two overlap, but the New York session closes at 5, and usually the steam is done at like 3, 4 o'clock. All right, you guys. I do not use trailer stops. Now, the last thing I want to touch on is the back office. Some of you were able to get into the back office. That's quite commendable. I've had some that had no issues with any pages, and some did. I want you guys to know that, of course, the back office is a work in progress. It's although some have access to it, I have not called it done yet. So, but if you're having problems with some pages loading but others won't, you might have to clear your cache. Go to your settings on in your browser, where you would clear out your browsing history, and make sure the cache is checked. Because usually, I think by default, oftentimes it isn't. So make sure that it's checked, so it will remove the cache. And then, in order to access the website, the way my permalinks work, you do not need the www. All right? All you need is this. All you need. All you need. You do not need the www dot. You can put http : but you do not need the www dot. I built my site this way. All right? So just make a note of it. If you clear your cache and you put in the web address this way and you still have a problem, it's stuff that this is something that I'm working on. That's why I didn't say that it was done yet. I don't put a stamp on anything being done until it's done. However, I did check it this afternoon, and all my pages on my end, after taking these steps, they all work. So that's what I'm telling you guys. If you're having problems with it, then that's what you need to do.
I love it.
Furthermore, some of you joined the group when there wasn't a back office being built, or I didn't have the infrastructure in place yet for the sign-in part.
Right.
So you do not have a sign-in. I know that. I do not need anyone to remind me. I'm very aware. The admin part of it, I'm going to handle. I need for each and every one of you to know that please be patient, because Rome wasn't built in one day, nor at night, but I'm going to get to each and every one of you. I'm going to provide instructions. If I can provide instructions that's global, hey, look, we need to do this, do that, or whatever, I'm going to do that. And I'm working on that, right away, because that's very important. We've come too far to get to this point to have people shaking in their boots and, all that stuff. So I want you guys to know that I am aware that some of the pages are not working, because I've had work some of the work done, I had it outsourced. It was work that was above my head, above my realm of expertise, and I had it outsourced, and that was something that I too complained about. But I figured out how to do it, and I was told, instructed how to do it, and it worked. So I'm imparting that same knowledge onto you guys. So I want you to know that that's the proper way of doing it. You do not need www. Only SoldOnEasyForex.com. Clear out your cash. You should be in the money. For those of you who need to get registered to the site, I will be providing instructions on how to do so.
Yes.
It'll be more of a manual process for you guys because of timing. I wish it wasn't that way. I wish I had decided to do a membership originally, but this thing really took off and it's going to continue growing. So that's the cost of doing things the right way. Grow. And as we grow, we're going to evolve, new things will